Welcome everybody to our Friday Q&A session. Glad to have you with us. As always, want to be mindful that trading, whether futures, Forex, options, stocks, baseball cards, it involves risk, and you should be mindful of that. You know, one time I traded away a Nolan Ryan rookie card. I'm still
threw away a George Brett rookie card too, so
I'm still bitter about that. But we know that we need to be mindful of the risk in markets, and it's one of the only things we can control, right, is the risk around that. A little bit about me. I'm Josh. I'm the founder of Trade with Profile. We've been doing this, close to 2 years around here, working on trying to come alongside traders. Also with me is JP, another one of our coaches, and we exist as a firm to help develop consistent trading skills. So if you find yourself where you're like, hey, I'm just not consistently pulling money out of the market, we're a good group to talk to, and we focus all of our discussion in our community around these three objective focus areas. So the 4 behaviors observable in every auction and how to observe them, the 4 questions to ask before entering a trade and how to answer them, and the 4 stages of auction competency and how to know which one you're in. And we look at these through 16 modules every week. Whether you desire to be a full-time trader, you want to be a hedge fund operator, or you just want to grow your retirement savings so it's not a spin down account at the point at which you go after it, these are all things that are very, very helpful to have mastered if you're going to participate in markets to that effect. So today we're going to talk about patience. The challenge around this was that overtrading, and then so we'll start with kind of an assumption. So overtrading always leads to lower expectancy and performance. I don't know of a study on the planet, whether Denise Scholl or Brent Steenberger, I haven't seen anybody who says that placing more trades and looking to be in a trade all the time leads to better performance. What does lead to better performance is having patience for good conditions and trade location. Now, the challenge is, well, how do you know what to wait for? And then how do you practice and develop patience? I was going to throw that to JP. How does a trader have some expectation around patience? How do you build patience?
I once heard a great story where a trader hired an individual to sit next to him, and when he started to get impatient, the guy would sit there and poke him with a knife to make sure he didn't get impatient.
That's awesome.
And it's a true story because it comes from a reliable source, I can tell you. So how do you do that? It's built. It's not done. Okay. It's like, how do you lose weight? You just don't wake up the next day and lose 20 pounds. It takes time, and you have to work on it on a regular basis. Working on with another individual right now that gets ahead of himself. Patience is the key, and everybody's, I got the secret sauce. I know how you're going to make millions. It's just this one setup. You see all the commercials, right, on thing. Just 2 setups, and I'm a real money trader and all this kind of stuff. Yeah, whatever. Okay, what matters is this: can you guys be patient to wait for your trades, not somebody else's, but yours? Okay, and then that is the key. If you can't, you are going to be sucked into that. It's like, again, let's talk about losing weight. If you don't extract the things that cause you to go towards them in weight loss, in other words, like i.e. all the sugary foods, all the good sodas, anything that's good for you, they're good to eat and taste good, right? Those are the things that you have to stay away. That's like patience. It's hard, but you have to start slow. So eliminate one thing, eliminate another, right? So, for example, a way of showing patience is in the morning when you set up your trades, you put alerts in, and if there's nothing going on, get up and get away from the screen, because it's going to teach you to be patient and wait for that stuff. If you sit there and look at it, hey, the market is a seductive mistress. Okay. If you give them time, it'll suck you in. And that's what patience is all about. And so as you get better and better and better with that, you can sit in front of it longer. Now, why would you want to? I have no idea. Because we talk a lot about if nothing's going on, put some alerts in and then get out of the way, leave, go do something else, get distracted by something else until those alerts help you go through that. Okay. Then the other thing is also the journal. Okay. Now I also have not only do I have my screens in my office, and I'll go back, I have as Josh is writing this, I have a TV in my office. Okay. And that TV is not for watching CNBC or Bloomberg or anything like that. It's actually for watching movies and sports events when I have nothing else to do in the marketplace. Right. Or I get up and I go do other things. I live in a nice warm environment, and so I can have year-round access to outdoors without being too cold. So I can go outside, maybe take a walk or something. So journal as well. Journal your feelings when you're starting to feel antsy about getting into markets and being impatient. When you journal that, you go back and read it. The key is not journaling. The key is journaling and reading what you're thinking and feeling. Like, go back 2 weeks and read what you wrote 2 weeks ago, and then see if you're making improvements upon that. The other one is also get a trade buddy. Okay. A trade buddy could be anybody, whether it be somebody like us or just a regular friend that you trade with, somebody you know, and then start having dialogue with them, have regular meetings, on I don't say a daily basis, but a couple times a week or at least once a week. And what you do is you talk to them about, hey, I'm gotten patient here. This is what I did. Break it down for them. Have them provide you feedback on that. And then start to work with each other. Likewise, you give them feedback as well. But it's a process, and understand that, because why are we impatient? And this is where I'll end it right here, and then Josh will take back over. We're impatient because we've been taught to be impatient in the world. Okay. We're taught to dig hard, work fast, get the grades, meet the deadlines. Right? That's just normal. We're normal, impatient people in the world. We get in line and we got to wait 10 minutes and we're trying to get out of the grocery store to go do something else. We become impatient, and then we start doing things that you regret later. You say something, you act weird, you do something that you wouldn't normally do, and then you end up having to go back with your foot in your mouth and apologize or something like that. So understand, it's not because you're a bad person or because something's wrong with you. This is normal. We're taught this in school from a very young age. So what we're doing is we're sort of unwinding that. I always say the best traders are the ones who can sit back and just say, I'm just relaxing today. Okay. Because they're not in a hurry to do anything. And that tells me they can be very patient. Okay, the old days, now this is on the screen. The old days when they had pits and stuff like that for futures, it was different. You had to be not only did you have to be impatient, you had to be strong and fierce and forceful and all this kind of stuff. But that's not the days we're in today. It's now all about patience and on the screen. So hope that helps.
Mm-hmm. I'll add just a couple to those. Have defined setups that you have traded over and over in sim. So you know what that setup and that trade that you're looking for is. Have prices that you are interested in before the auction takes place. So, for example, today there's really only two prices I'm interested in doing any business at in the NASDAQ anymore, and that is either 73.43 or 74.13. So if I don't hit those prices, then there's no trade. I'm not interested in those, in doing anything today.
And that takes what Josh is talking about takes time to develop that. It took me time, but I'm to the point now where I guess I'm over patient now. I'll just like, okay, I'm not interested in that stuff. I'm leaving.
Mm-hmm.
And maybe because I'm just like, okay, I don't want to get caught in this low grind and this low, look at today's market today. We're looking at it right now. Josh has his 5 minutes up here in between his larger profiles, and we're just going sideways. You could get chopped up today. I have no interest in watching this. And if you were in the channel today, you saw me say that, I don't know how many times, like, okay, I'm not looking at that.
Mm-hmm.
So,
Yeah.
and then I'm going to say one thing, because I know some of the questions, and you can ask questions, and we encourage you to ask questions. One of the things that comes back is going to be, well, what if I miss a trade? What if a trade sets up? Okay. Well, like Josh said, if you have a defined setup, okay, you know what you're looking for, and you're waiting the market to come to you, and you have an alert set.
Yeah.
Okay, no big deal. You can catch that trade. But if you're looking for something to trade, then that tells me that, okay, you don't have a defined setup, which is now that's another issue. Okay.
Mm-hmm.
So, again, there's a lot of things built into this. And once you start to develop them out, it's a beautiful thing. It really is. And to me, I see when and Josh, you can, we don't have studies on this. First, we don't have studies on the number of traders and if they're impatient, what the results are. But I will tell you, everybody that we've dealt with in the past and that I've seen as a personal trader and a professional trader, I will tell you that the ones who get in the most trouble are the ones who are most impatient.
Mm-hmm. Yep. Absolutely. I pulled up this soybean chart as an example of just something that I'm waiting for where I have an alert. And so I'm looking for a trade I call a second move that would get me long soybeans. And I can tell you my target right now is 901. So more than 10 cents away. That's about $500 per contract. And what I'm looking for is you can see this really big. And this was part of my plan this morning. So you can see this really big move here, big selling volume. So we had a crop report come out, and the initial move was lower. So that's kind of the first move is lower, and it's a strong move. So that should, as long as they kind of defend this area, that should lead to lower prices. I've got an area down here, 874. However, if they come back and trade above the base of this big spike, then what's happened is these sellers who should have had follow through didn't get follow through, and they're now stuck potentially. And so I can look for opportunities to be long up here and have my risk set. Depending if we poke above this, I might set my risk, like down here at 884. So this is kind of my risk window, and I'm looking up here. And this is a multi-day swing. It may take Monday, Tuesday to get to that price. But I like that price. That it's actually an untested inventory level. It's below a gap, and it's after the behavior of this. So, naming my trade, I know it's called the second move. I have an alert at 889.75. So unless that alert hits, then I don't get into the trade. So it may not hit, and then even if it does hit, I don't automatically buy it. Then I look for a smaller time frame trigger I can lean against to further get myself in. But I don't even look at that chart until I get there. And I can tell you a trade that I was looking for today that I did not get was something that we call an IB extension go with. So this is a trade where you have an initial balance. Your first hour of trade is formed, and once that extends, you're looking for a pullback to go for further extension. And we're looking for the trade to get down to here. Yesterday's point of control is untested. So this whole zone down here at 43.40 to 48 was an expected target. And so what I was looking for is they were moving very rapidly. So you can either go with the extension. I was waiting for a pullback. They didn't before they got really to yesterday's close. and I was expecting him to go down here. So I was looking for an opportunity to be long once they cleaned this up. Like if they cleaned this zone, then I would have been looking for a rotation higher, and they just never got there. So now you can obviously look at this and go, well, they did rotate higher, and they rotated higher to the tune of about 40 points. So yeah, I mean, I missed that. I totally missed that because I had an alert down here. I wanted to see this get cleaned up and tagged, and this is multi-session volume, so that should have supported the auction. So I should have looked for that thing to come to slow the auction. They just didn't get there, so that means no trade. Alternatively, you can see I've got another one of those higher. That's why this 74.14 is up here, and it's unlikely today that I'll go look for that. But if early, an hour or two earlier, if we had squeezed up into this area, I was going to look for a fade back toward today's volume. But you can see we've not gotten up there, so no trade there too. But those are just a number of the trades in my trading playbook that I know what to look for, and I know the conditions around those. And so, I'm waiting for those conditions to be met. If those conditions are not met, then we don't place a trade. So
let's talk about that a little bit more, Josh. So first of all, I want to ask a question to you guys. Has any of you guys, first of all, there's no wrong answer. And I do know the answer already, but I want to hear it from you. Because if you say you have not done this, I want to talk to you personally, because then you need to get to Wall Street right away and start finding a firm to trade with. So post some of the times you were impatient, or give me an example of a time you were impatient in there. And I just want to, first I want to see what your comments are, but then also, but to Josh's point, listen, whether you're talking profile or anything else, there's really a few trades in the world of trading. So let's be real frank with one another. The market does one of three things, right? It goes up, down, or sideways. I think we can all agree with that. And that's the first thing that I ever learned when I got into the trading arena. The market does three things: go up, down, or sideways. Now you have to decide what. Okay, what is the market trying to do? Is it trying to go up, down, or sideways? Then from there, who's in control at the moment? Okay, then from there, what type of trade in your plan, okay, fits that criteria those questions you just asked yourself? All right, now let's go back to the trades. We can either fade a market, and what that means, if you're not familiar with that, is that when we get away from the market, it gets too far extended, we want it to come back. So if it's going in one direction, we want it to come back the other direction, or what we call back to the mean. Okay, that's a fade trade. And then the other side of it is a go with trade, right? Josh talked about that just a few minutes. A go with trade is when something breaks out or breaks down, okay, then we go with that, and price is moving one direction. We're going to go with that trade on that. Okay. Right. Then we have what's called a pullback trade. Okay. Which, price breaks out, comes back. We look to get involved in the same direction after a small pullback, which is normal. Pullbacks are normal in the marketplace. So that's it. Pretty much that's it. The types of trades that you can have in there. Now we use things in the profile that we talked about. We use, volume areas. We use high value area, low value area. We use IB extensions. We use IB, et cetera, et cetera. Those are just the tools that we use to identify the different types of trades in our trade setup. Now, here's where the rubber meets the road for you. I can give you one of those trade setups today. That is the simple part, okay? The part behind it that Josh talks about is we have the trade setup, but what's the criteria behind that, okay? So example, we talked about this yesterday about an IB go with. We had a situation where we had, you go back to yesterday's market, Josh. Mm-hmm. Okay, so can you take out overnights on that? So is it possible?
Yep.
Okay, thanks. So what we did, showing yesterday's trade, we had a big down day the previous day. And then we came into the day and we started developing the IB, which is the first 60 minutes of trade. Well, there was an IB go with opportunity down at around 73.21. You can point to that. Okay. A lot of us said, no, we're not taking that. And the reason we were is because we were still inside. In other words, the criteria for our trades were not met, even though it is a trade setup. It's a go with trade setup that a lot of us use on a regular basis. But why wouldn't we take that trade setup? Well, because it didn't meet our criteria. Now, part of the criteria is if we're inside of a range of a previous day's range and that go with is happening, we're probably going to ignore it. And of course, there's things like, okay, do we have the volume for the day? Is it with us? Is that's part of our criteria? And there's a few different things that we built into our trade setup, okay, to say that, yes, that's a high probability go with or a low probability go with. And therefore we ignored it.
Yeah.
Now, and guess what? Could you have made money? I don't, yeah. What was it? How many did it go down? It's 21 to what?
73.
90. So yeah, so
area low.
There's some money in there. And are we sitting here crying because, oh, we missed that trade? No, we traded exactly the way we said we were going to trade. We weren't.
Yeah.
But
the
guess
better
what?
trade, you're going to talk about the trade that we did take?
Exactly. We did get the reversal trade, or what we would call when it comes back into the range on the deal. So we got the reversal trade, or we faded that move.
Yeah. So
okay?
we initiated the position here and peeled it off here.
Exactly. And that was a $480 per point trade. So per contract trade. Sorry. So did it work for us? Yep, absolutely worked for us. But we knew our criteria and we were patient for it. Now we could have seen that move go down to 78 and say, oh man, we got to hop on this thing. Let's hop on it. Right when we hop on it, thing reverses and kicks our butt, right? And that's what impatience does. But no, we were like, okay, today we still feel that this could be an inside day. And so we'll take the rotational side of this, and we did, and it worked out great. Now, does that mean it's going to work out every time? No, that's not what it means. But it did work out on this way. So going back to what we talked about in patience at the very beginning is understanding your setups very, very well. We talked about this just the other day on one of the calls. Which call was that, Josh? We're talking about owning your setup. So whether you are in another industry, which most of you are, or whether you play a sport, let's talk about the highest performing athletes in the world, like Tiger Woods and some of those in golf. They own their golf swing. They own their process. They own it. And when I mean own it, they know every inch of what's going on, what the criteria is, what's the environment need to be for them to be successful. They know what courses they play better. They know, what weather they play better in, et cetera, and they know how to adjust accordingly. And it's no different than you being a trader. If you really want to be a great trader and you want to become successful and consistently profitable, you need to act like a professional. And I don't mean to say that like, oh, you got to act like you own a business. Okay, that's dumb. That goes without saying. But I'm saying be like a professional, prepare like a professional, have your setup like a professional. Know it, own it. Okay, don't go around in what we call style surf. Oh, that didn't work today, so I'm gonna go find another type of trade. Oh, that didn't work. Remember what I said in the beginning. There really is only 3 things the market can do: go up, go down, or go sideways. So how are you gonna trade them? And so therefore, own that area. We own that right there. We know those trades. Josh and I can do and a lot of guys and a lot of people in our Slack channel can do those trades in their sleep because they know they know the IB. Especially, we have one gentleman. I don't think he's in here today. Let me check. No, he's not. He is a full-time trader. He's phenomenal, and I can tell you when we have a smaller than normal IB on crude oil, he is all over that go with on the IB. And I don't know his stat. I'm gonna have to ask him that, Josh. But I would bet that that's probably his best winner out there.
Yeah.
And he knows that trade left and right. Matter of fact, when we see it, we're like, okay, he's on it. We know he is, right? We know his trades because he knows them so well. So guys, I guess I'm rambling a little bit, and I apologize. But what I'm trying to get to is this: it's a process, and part of that process is understanding your setups, your environment around those setups, and stuff like that. Now, does that take a lot? No, it doesn't take a lot, but you still have to know them.
Yep.
What's the difference between mean, reversion, and pullback trades? Well, pullback trades are normal on all time frames, Tony. That's a great question, by the way. Pullback trades are normal on all time frames, and they could be considered.
I can draw one for you.
Yeah, I
Here.
consider mean to reversion when things get so far away. I mean, on a daily basis. I don't look at mean to reversion on a shorter time frame. Go ahead, Josh.
Let's look at a pullback trade today, where you could have potentially gone with extension to the downside on the NQ. So here's the initial drive on the open, okay, that got us to close the gap, and then they came back and balanced in this area, okay. So here's the first push, here's the second, and then see these three, you know, this strong selling right in here, okay. That's a pullback. The auction pulled back and then kind of reloaded and balanced for the next push. So how you could enter that trade is particularly this move right here was the first kind of there was a engulfing 5-minute period. You would have been short in there with your stop above that, which would let you capture that, and your target would have been yesterday's point of control. So that's a pullback. You see the first, then this is a great one, because this is where traders get caught, is you see a move like this and then you think I'm going to miss it. So then what do? You get short here. And then what's the auction do? It goes the other direction. So then what do? Oh, I must be wrong. And then, you know, if you're really over trading, you flip long because you think, oh, I must be wrong, when really all it was doing is it was just pulling back to reload for the next push lower. So anytime you see, this is a great thing to do. Anytime you see an impulsive big move like that, is to see if the auction, you know, where is the base of that. And there's actually a second place that you could have potentially reloaded. It was on this impulsive move here. Strong volume, okay, is, you know, if they had pulled back up into this area and not taken out the base of that where that started, so you're going to defend the start of this move, you know, down, and then if they had pulled back and then rotated back over, that would have been an opportunity. In this case, they didn't. They just powered lower, so you didn't get a chance to reload. Does that make sense, Tony?
Now, Josh, go to your 5-day and let's look at the reversion to the mean.
Yeah.
Now, Tony, while he's pulling this up, a lot of people use like Keltner channels and stuff like this, and then it has a 21-day, you know, EMA in it, and they'll use the 21-day as a mean, and then the I don't want to say it's a pullback, but that move back to that, first it has to extend and then it has to move back, and that's a reversion. And it's mostly on a daily basis. Most pullbacks happen on all time frames. And I would say reversion of the mean would in my book, and where I would look at it, is reversions would only happen on higher time frames. But Josh, let's look at the 5.
I would diverge. So they're happening. This takes time to see all of this, because JP's right. They happen all time frames, and the challenge is which one's kind of pulling. So like the auction moving this way, where here is the most traded area of the last week. Okay, so that's price reverting back to that. But then when the auction moved higher in the session, that was price reverting back to value that was up here. So they're both mean reversion trades, but they're two time frames operating at the same time.
Correct, and that's where people can wind themselves in the ground. So as Josh mentioned, it's good to define that for yourself. Like for me personally, my definition is I won't look for a reversion to the mean unless it's on a daily basis. So for example, I asked Josh to pull up the 5 and the 20. So that is my reversion to the mean. So when we get too far out on price on my daily basis, away from the 5-day and the 20-day POC, developing POC, that's when I look for reversions back to that number right there. I'll start to look for opportunities at that point in time. And then my pullbacks, I'll use pullbacks throughout the day on shorter time frames, 30 minutes, 10 minutes, et cetera, to either get involved with a move back to then or whatever else I'm trading on that.
Mhm. So here's what JP's talking about. Here's the 5-day, here's the 20-day, and you can see we're trading on that large number right now, actually in 3 different time frames. So this auction's getting ready for another move.
And hence my reason today just to go, oh, there's nothing here.
Yeah.
Until we get a move.
Yeah. Which
So,
you may not actually know unless we can take out this week's lows or last week's highs.
So this number, this 5-day POC, is sort of a developing number all the time, so it can shift. But let's say hypothetically, if we look at Josh's left chart, okay, it's a 2-hour chart there. Can you just blow that up real quick, Josh?
Yeah. Another pencil.
Okay, so we made lows at around 58.88, I think it was, back in late December. At that time, the 5-day was not where it is now. Okay, it was still far away from that number, but we were looking for an opportunity at that point to trade back to the 5-day. In my book, the mean is that 5-day or 20-day number, and depending where they sit, if we get too far extended away from those numbers, one of 2 things are going to happen. Either we're going to snap back and go back to that number, okay, or that's going to shift down towards the market, and that will tell us 2 things. Is the market weaker than we actually expected if we get a big shift? Now, you can see here we got a big shift in our 5-day up to a higher number right now, and because of that, this market's pretty strong, right? So we're going to take that into account as well. However, I will still look for opportunities to trade back to that number based on that. That is my reversion to the mean. Okay, that's also a reversal trade.
Yeah. Yeah. So just to clarify, guys, it's like right now, here's that 20-day number, which, by the way, this morning it migrated up. It was around here, and it migrated up. And how this happens is every day you slice off data from back here, and then you add a new one. So that's how it changes the picture here. Mm-hmm. But here's this key level. So if we trade up to like 75.54 and we move really fast, so price moves faster than the value does. So, that's where somebody can get, it's like an auction that can get ahead of itself, right? In fact, that's what happened last week. Look at this big move here, and then the move back. Where did that move back to? It went back to the area of value from that week. Like that's a reversion trade. Now that's at a larger time frame, right? So again, depending on the time frame that you're operating in and how your playbook is built, whether you're looking for intraday type activity or multi-session activity, that's the kind of stuff. Let me give you an equity example just to kind of slow things down. Like if you're not looking for all the time trade, like here's the TLT. Okay, so this is the 20-year. Instead of trading like bond futures, you can trade the TLT, right? So look at the 20-day value down here is at 121. So there's $5 of difference here. Now we could, if we spend a little bit more time here, we could actually migrate that up, and that would change the story. But right now there's a divergence between the price and the value. And in fact, if we like trade up to 127, you can just see that this profile is going to get thin. So where's the place that auction is most likely going to come back to? It's going to come back here first. And if it breaks here, it's going to come here. And then, it could also run all the way back to there.
So that's actually, I'm glad you brought this up. I didn't think you were going to bring this chart up, but to me, that is that's an opportunity. Mm-hmm. So in my book, I'm looking now never on a Friday, of course, it would be on a Monday or Tuesday, but I would be looking for opportunities to reverse back to that number. Okay. That doesn't mean I'm blindly getting into the trade, and it's not a recommendation by any stretch. I'm just saying that for me is what I would be looking for and am looking for at this point, also through the bonds and the notes. So good point. It's a good example is what it is. So Can you use other things? Yeah, you can use anything you want. I mean, I know a lot of guys that are successful using a 21-day EMA on a daily basis. That is a fairly consistent reverting type of number. Okay, so whatever you use it, what matters is that you know how to use it. Okay, and this just is the one that we use, and it works really well for us. So hopefully that helps, Tony. I know it's a long answer to a short question. So
I want to cover a question that we got asked earlier. One of the guys in our community. So we've been talking this week about statistics, behavioral statistics, and just to help behavioral statistics. I mean, you can get in trouble with statistics where you're building your trade around a certain statistic, as if you're trading it like it's a guarantee when it's not. But one of those statistics is something that we call an expected move. Okay, so that you can compute the expected move for any product to about a 70% probability that the product will stay inside of that price range on a given day. And you can use that to set some expectations of what the range might be. So for example, crude oil this morning had an expected range of about $1.09. Okay, and when we opened this morning, so if you take the high at 60.75 and you include the low of 59.15, okay, did it exceed, or does it still have expected range yet left to go? If the expected range is $1.09, we got to what, $1.50? Okay, so we exceeded the expected range. So note how the auction behaved. When it was exceeding that number, statistically it was stretched, which gave the opportunity for a move back into this range. And even though the auction trades back into this range, it's actually not adding to the range number unless it would make new highs or get below the Globex low. So I was talking with some of our traders this morning about the NASDAQ, because if I took, the NASDAQ had an expected range today, we're here real quick, of 82, and this changes every day based on the implied volatility. It's a little bit tighter than it was yesterday because the volatility, market's expecting less volatility, at least at the moment. So about 82 points was the expectation. So here's the low here at 73.48. So what number gets me to 82 points of expected range off of 73.48? Anybody quick on the math? Okay, so 74.20 would get me, so that was the expected range if the Globex low held. Right, so it's it's still possible, and in fact I had a decision level up here that's inside of that expected range. So early on, when we looked like we were coming back to test the open, there was a potential that we were going to break and then get up to that, and that would have been totally reasonable and expected. But what it does is it kind of helps you set some expectation on the auction. It also helps you kind of stay out of trouble. So like on the crude example, where we've totally outshot the expected range, what would have to happen to be prudent to be long crude this morning, right? And like where's your target? Because you've already, like on the open, you've exceeded what the market was expecting the thing would do. So is it prudent to be long for further extension? We would say no. We would say no, that would be not prudent. You would want to see some kind of pullback back into that range to get the stats in your favor, or you would look for an opportunity to be short back into that range. So that's a way to look at using stats. I'm trying to think if I had any other questions that people had sent me beforehand. I know somebody wanted to know a trade that didn't work. In the trade today, that I was looking for that fade. I really wanted this fade earlier here, and I missed being long, so I missed this 40 points because of that. It was a bummer.
It happens. I mean,
yeah, it happens.
listen, you're going to miss more trades than you get. But I know people, if you're in the Slack with us, the one thing that I always put in, and I know everybody just probably rolls their eyes at it, but listen, there's going to be thousands of more trades for you to take. So one trade isn't going to make your career, but I promise you one trade can end your career. So
I'll show you a trade that I took this week that I got stopped out on. And here was the target, and here was the entry, and here is the stop. Fair enough. So this is live cattle. Live cattle had come back to an area. So you can see this big area right in here there's lots of volume in there. It's a big composite level. They've returned back and made this big push, and you can see there's an area right in here where there's single prints in this profile, and it was a big range day. So the auction opened, pushed lower, gave some excess to the auction, came back into this range, and then made this new. So this little 30-minute period here where they made a new 30-minute high. Okay, so I was looking at that as, hey, we had poked below this volume area and came back above it. So then I could use that as a risk parameter, and I was targeting, first to get to these single prints and second to get up here. So my target's up here, and I bought somewhere in here like this 119.75 area, and I was anticipating that we were going to take out this new high and make it a neutral day and go clean up to 123.75. Okay, so when I got in, my risk was the initial balance, or not that place, the initial balance low, which is right here. And you can see that they obviously did not extend and came back and took me out. So here is my entry, here was my target, here was my risk. And this is a great example of I didn't wait for confirmation, which confirmation would have been that they actually had extended that initial balance high to go neutral. I was trying to be cute and expecting it to go there, and that's what happens. Yeah, these things are done today, JP. I was just showing everybody that we're under quite a bit below volume on most of these products, or below their average. All right, what other questions can we answer?
How does Josh move the meat market?
Apparently I didn't yesterday.
I was disappointed. I thought you'd make it move and go in your direction.
Well, part of it was size. I was real small, but when you set up criteria for trade setup, are there subjective experience or objective with statistics to back it up? This is a great question. It's both. I will tell you that the trades in my playbook, I started with statistics to kind of help me know that that's a reasonable behavior to expect. Here's an example. What I mean by reasonable behavior to expect. So let's say you wanted to play earnings on a product, and earnings were coming up, so you believed that the market was going to go up, and you bought a call, a really cheap call. Say you pay, well, I'll tell you for example. I had one Netflix, this is probably 7-8 years ago. bought a call for $50, and the next day that $50 call was worth $1,275. So that was a good day. Right now, JP, why was that a bad trade?
Because it was a lottery play. That's why. You didn't
Yeah.
have any. I mean, it's terrible. Well, it's just like my GE play too, right?
Right.
Same difference. I ended up buying calls on GE when it got crushed, and then I'm sorry, it wasn't. I was thinking I did buy calls on GE too, and that didn't work out well for me. But PG&E, which is Pacific Gas and Electric, and when they were blamed for the fire, they got crushed. So I bought calls on it. But the next day I woke up and they said, no, they weren't going to blame PG&E, and my calls were multiples. So same reason that one was successful and why it was a bad trade.
So here's why my trade didn't work, Tony, or why that trade would work. How to think about the time that it did work, but never take that trade again. Is so like if these, this is a product that's moving, okay, at any given time, if it's got options on it, there's kind of a cone of expectation of potential prices sometime in the future. So if this is a timeline, right, there's some expectation. Well, the options are priced to take this into account. So this is where this expected move comes into play. So I could tell you what the probability of the S&P being at a certain price 6 months from now. Okay, I could give you, hey, 70% chance it's going to be within this price high and this price low, because that's the way option markets work. It's great, very effective, very efficient, because you have two-sided participants. So if I buy some cheap, cheap call on some product, the only way that this thing makes money is if it vastly exceeds the expectation of that range. That's the only way. If it moves, and then, I mean, even if it makes a big move and stays inside here of whatever this expected thing is, this thing will shrivel up and it will be worth nothing. I mean, I had that happen because, after I had that one trade, this is how I learned that it was not a good trade, was, I started doing that every options, every earnings. Like, oh, I'm going to buy a call. I'm going to buy a call. Or, buy a naked put, buy a naked call. And I basically gave that money away because it just so happened that one time that Netflix so exceeded expectations that, it went beyond that. So I actually was experiencing a trade that had a, less than 20% probability of success. So the statistics help you kind of set what's a good expectation. So, that's where, like today, we have IB low extension in the ES, for example, right? So I can go back over 1,000 trading sessions and know that there's only a 30% chance I'm going to see 28.37 today. Now, it could happen, sure, but it's not likely. And so that's where the stats help me. And in terms of like what I'm looking to do when I have that IB extension, as I'm either looking to go with that extension, or I'm looking to fade that, and that's where the subjective part of it comes in, is that we have additional conditions that we lay on top of that in terms of order flow and price action and how the auction's developing value that help us refine it. But the statistics always help you kind of go, okay, well, that's a reasonable expectation to have, like another one is like on a gap. Okay, so like with crude oil gapping today, so we call a tier 3 gap, and a tier 3 gap is where you basically gap what the expected range is. So when crude oil opened today with the expected range at 94 cents was the expected range for crude oil today. So, here's the gap open at 60.45. Here was the high of the prior day at 59.30 or 59.40-ish was that high. So we've already hit 90 cents of expected range. That's on the open. So when that happens, there's only a 3% chance we're going to get all the way back here. So it just helps you. It helps you have a really healthy expectation of the auction, and then you can layer the subjective stuff on top of it. It's a great question.
It is a great question, and so that's Tony's question, right?
Yeah.
So Tony also had a portion of that question that say subjective.
Mm-hmm.
Nothing really is subjective that we do.
subjective to me is like, oh, it looks like it's going here, I'm just going to take the trade. It's all defined and very objective, I guess, if you want to say, because we've tested it, because it's one of the just trades. It's a trade that's happened multiple times for many, 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 many years, and we use that trade. We put the context around it to increase our probabilities. So a great example today is we are on crude. What did we open up at crude? I was 60, 70 or something like that. What was our opening print on that? 60.45, wasn't it?
Yeah. Yep.
Okay. So, we're opening up, pretty stretched out. You look at the last couple days of trade, and we've come a long way. What was the low 2 days ago? 58.35, right?
Mm-hmm.
So we've gone from 58.35 to 60, and what's today's high, which is around 60, 70.
Yep.
So that's a good $3 move. That's a pretty, I would expect price to pause in here or start to, and what you talked, the reversion, right? So this morning with the gap up, it was either going to continue up and go and crush people, or it was going to get all these looky-loos stuck in here long, thinking we're going to 70, and they were going to go ahead and pull back a little bit, which they did. They pulled back a little bit here. So that was, for me, that was a play that I was looking for coming in this morning. I was looking for some type of reversal, and it happened, and we got a little bit of it. But we were also looking to go long too. I think a lot of people were looking for opportunity to get long this market. It hasn't, and the crude didn't happen today. So, anyway, I hope that helps as far as understanding. Nothing is just subjective. It's just, we don't randomly pull this stuff out during the day. It's, and we'd ask you not to do the same thing as well.
I guess, would you say, like, in terms of defining subjective versus objective? So an objective would be something I could say, like for example, here is, that's strong selling volume.
Mm-hmm.
I can objectively say that. What I don't know is that strong selling volume that's likely to continue, or is that strong selling volume where somebody was late to the game and they're getting squeezed out of the short?
Well, you're right. That remain, and we don't know. And so maybe we need to use different language. Maybe it's reactive and defined.
Right. So like, it was objective that was strong volume, but the fact that it got no follow through to the downside, and in fact, they came back with strong buying volume, that's what makes it more objective, is that you go, oh yeah, that was just late shorts that got squeezed.
True. But then the subjective portion of it is, okay, I'm going to take that trade to the downside. Well, that's subjective, because you have nothing to lean on. You have nothing other than their strong volume there.
Right.
And if it's not in your trade plan, you haven't tested it over a period of time, I wouldn't take that trade.
That's right. Great question.
Yeah, it is. It's good discussion there, guys. All right, anybody else have any other questions or anything? We'll answer anything. Tony says thanks. Any experiences you guys want to share? And just understand, when we ask you experiences to tell us how you do, don't be embarrassed at all. For one, I will promise you, Josh and I have made every mistake in the book, period. Yeah, there's no way around it. I mean, can one get the expected range numbers from TOS? Yeah, absolutely. It's IV.
It's a really easy calculation, is that you just have to get the implied volatility number. Okay, so you write this down. Implied volatility times the last price times the period of expected range divided by 22 or 252, and take the square root of that. So it's
there's going to be a test on this.
Here, I'll type it out so you guys can see this.
Okay. And when he says by the last price, what we mean is the last price of the trade day yesterday, previous day.
It actually can even be just it updates in real time. But as far as expecting, for the next day, I do the last price, or you could do the closing price if you want to set one up for your next day, right? Times the implied volatility times the, let's see, how do I do a square root? Square root of 1 divided by 252 would give you, that would give you the expected, that equals the expected move for the next session. So if I change that 5, now it's the expected move for the next week. And if I change that to 30, now I've changed it for the next month. And I can actually compute an expected high or expected low. Pretty cool, huh?
It is. And a spreadsheet's even cooler.
It's even cooler.
And there will be a test, and we will not grade on a curve.
Yeah, and this is that, like here you can see a toss. I've got the implied volatility. It's a percentage right here. So that's the number that you use. You use that percentage. So you would do, for example, the crude is at 25 points. So you do 0.2521 in your calculations, and then that's where, like on this chart, I can see how implied volatility, because it changes. The market has different expectations of how much it's going to move. But yeah, TOS offers that. All right, I think
I'll say one thing here lastly before we leave. I don't know if you noticed, but Lyft had its IPO today.
Oh, did they?
They did, yeah. They opened up at $80-some. I watched it a little bit. Guys, that we're talking about patience, and we're talking about subjective, objective, and stuff like this. That's going to get a lot of headlines, okay? As you can see here, anybody who bought that open is getting hurt right now. So what are they down? $8 today, I think it is. Yeah, $8.
Yeah.
So this is one, guys, that it's probably, do I think Lyft is going to be a good company? Yeah, I think it's going to be a good company. I think, the Uber is here, the Lyfts, they're here to stay for a while, because their service is one, needed, one, it's good. And it's simplified. And so, but that doesn't mean you should run in and trade this thing tomorrow. I have a few rules behind it, but I know this is the patience that we talk about right here. Wait till the knife sticks in the ground. Wait till all this crap and the headlines shake out. Then I think there's going to be some good opportunity for Lyft going forward if you are an equities trader. And I say that because I know there's just going to be headlines all over the place, and the weekend news is going to be talking about the Lyft IPO and where it opened and how good it is and blah, 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 blah. So maybe start your patience, your journey to find your patience. If you're tempted to look at something like that, I would just say it's like Brussels sprouts when you're a 5-year-old. Turn your nose and go the other direction.
That made me think of Snap.
Yeah.
And the IPO there. So you can see that, the IPO was released. They released it at 24. They traded up to 29. So that's like from release date that week.
Yeah.
So you can see where we're trading now. What's interesting is you can see they traded sideways for a long time and developed some value around 1344. So this is where Profile can help you make better investing decisions. Is you can say, hey, well, once this slide stopped and we saw some activity come in the opposite direction. In fact, when you saw this big, did you guys see this big buy? See this big buy here on earnings? Okay, holding that area right there gives you a pretty nice, target to get back to value. And this is the kind of, this is the time of time frame somebody's looking at if they're doing like, they're holding a stock, right? And it could go back to 18, and then you basically defended 4. That's a great risk.
Yeah, actually,
reward.
I think 13 is the magnet for sure. I mean, wow. Okay, hey, erase your stuff there. That's a great. Actually, this is a good setup, by the way. This is a great reversal setup. They pop off the bottom there, and they hold it for a couple days.
Yep.
And then they ignite the candle off of back further off the bottom at $4.82. So they have a 2-day run. They take out that low of 48, that candle at 48.20. So they take out that low or the high of that candle and they hold it above there. They start to accept price on there. And you see the high volume in that area right there? We start to hold that high volume and accept price right there. Okay, so that gives the opportunity for somebody to get long in there at around $6 with a stop just below 482. In the equities world, that's $1.40. That on a swing trade, that's not a big stop.
No.
Okay, then into earnings, which that's a tough one. I would never hold into earnings. I'd go to the option side of things. You get this monster igniting candle in there, which would tell you, does somebody know something before earnings when you start to see a pattern like that? Maybe. So now we have this, but we're so far away from that volume or that POC on a larger composite that it's a magnet.
Mm-hmm.
And I agree with Josh. I'm sorry, I missed this one. Darn it. But Josh, we were talking about that the other day, screening for these things, man. That is a beautiful, beautiful opportunity.
Yep.
I can tell you, I was not in it, full disclosure. I wish
Yeah, I didn't have it either. But this is kind of, I use a template like this to say, this, give it a couple years. It may take a couple years, because you think about when someone does an IPO, you're basically unleashing value out of the company, right? That's where all the founders make money, is they make the money on the IPO. They're finally realizing the said value of the company, and they're pricing it above what their books show, and they're now flush with cash. So if you're buying that IPO, you're buying future value of the company, which is probably at some multiple beyond what the actual value of the company is. So it's really prudent to wait for some kind of pullback, to get in there. I mean, if we go back, let's look at Facebook. Here was the initial like 38, or it was somewhere around there, 38, something like that was the IPO. And you can see they pulled back for a good year, and it wasn't until they had this move here on really big volume that got them back to the IPO level, and then we haven't turned around since then.
Yeah, and I actually still own this from 23.
Nice.
So 23 was when we broke the IP price and held, and that's when I got involved with it. So you're right. There's opportunity in the IPO side. You just have to be patient. It's not on the first day. It's probably not even in the first couple months.
Yep. Right.
So, but there's some good, and the good companies come out. It's a great opportunity to get on board and go. Just pull up Google real quick. I'd like to see. I don't remember what Google opened at, but man, if I was halfway smart, I would have bought that.
They've split too.
Yeah, I know, but it still, just look at the curve.
Yeah. Yep.
There's your curve. So let's say you were patient and bought, on the reversion to the mean on the first one, which would have been almost a full year after you got into that, or after the IPO, then, that's a heck of a move. Holy cow. There it is right there. Bink.
Bink. Let's look at BABA real quick.
There's a few of them.
Yeah.
Facebook was good. BABA was good. So when you guys are looking, again, the profile helps us on this every time, guys, because it tells you where the volume is, where it could go, et cetera, et cetera. So is that the IPO?
Yeah, so the IPO is right here.
Yeah. So, okay, look at this. This is beautiful. So look at it. We go down, we pop up, and they start selling it off for a few months, right? Or actually more than a few months, almost a year. And then they start to they start to develop a value area down there. Okay. They start to develop high volume. Then what do they do on what's the date on that? July of 2016, on earnings, they pop it up. And what did they do? They hold that volume area right there.
Mm-hmm.
Okay, they come back. There's your pullback on a larger time frame. They pull back and they hold that volume area, and then what do they do? Off to the races, my friends. That's the trade right there. That's a good trade.
And this is like your pullback. Okay, so here's the pullback. Here's the entry, and that's the type of behavior that I would look for. Is when they made that new high, I'd have a stop here to defend, and then you could just let it go. Very cool.
Yeah, good opportunity. So I hope that helps, guys. So,
yeah. next week, we're going to be talking about defining decision points for a coming session. So if you're struggling to find a level that you want to even wait for and to know what to wait for, it's a great chance to skill up on that. Some next steps, ways to practice patience, is just know the conditions of your trade setups and wait for those conditions. Use alerts. Sometimes I'll use a stopwatch, and every 30 minutes I'll wait. I'll just come check every 30 minutes just to keep myself away from the charts and come back. Journal how many times you force a trade. So like if you force a trade, mark it at that. Say, hey, that was a trade I didn't get confirmation. I just wanted to be in a trade, versus one that you did wait for confirmation. See the difference in those. Always the opportunity to do a week of the pathway with us, and continue to interact with us on Twitter, Facebook, and if you ever just kind of want to know, like, man, I just would love to talk to somebody one-on-one and get some some insight. We'll give you a fair shake on some ideas on kind of where you're at and where we think you might look and explore, and that may be doing some work with us, and it may not. We may say, hey, go try this for a while, see how that works, come back and talk to us, because we're here for your success, and that may or may not mean doing any work with us. But really appreciate everybody hanging out with us today, and we'll look to be back around next week.
Yep.
Talk to you soon.
Yeah, have a good weekend, guys. Take care.